it's Tanya. Thanks for dropping by. As promised, I have brought you a guest today to talk to you about mortgages and about the market. So let me introduce Tim McCaroll. He's a mortgage broker that I use often with clients. So Tim, tell me about the market. How's it going?
Yeah, so right now with the market it's kind of volatile. It's because a lot of people are looking at the market kind of being a little intimidated by the fact that the Bank of Canada has risen interest rates over the past four announcements, I guess. The next rate announcement is actually October 26th. So mark your calendars, October 26th is going to be the next rate announcement. We don't know whether they're going to go up or down just yet. I'll kind of talk about where we are right now in the market, and then maybe we can kind of go into where we think it might go to. Okay, so right now in the market, obviously the Bank of Canada has risen the interest rate by 0.75%, okay, which put the overall percentage at 5.45 and so on and so forth, okay. Banks and lenders are actually offering discounts off that. There's a variable and there's a fixed. All right, now the variable is around 4.5%, where the fixed can range from 4.6 all the way to 5.9. I've seen actually right now. Usually banks tend to be on the higher end of that scale. A lot of A lenders that are not banks, that don't actually have a brick and mortar store, they're still offering around 4.6, and that's even with fixed. So that's still definitely a good market to be into for sure, but it's up to you, the client, obviously if you're risk tolerant. So that's kind of where we are right now. Now, one of the biggest things I like to talk about is what happens if the rates go up? What happens if the rates go down? Let's say next October, which is kind of a big kind of sticking point to a lot of people asking questions.
Yeah, big question.
And I can definitely answer it if you want. Yeah.
Sure.
Okay, so if the rates actually do go up October 26, most likely they'll go up by 0.5%. Okay, and that themselves is still being a little aggressive. Okay, but let's pretend it goes up by another 0.5 point. So it goes up to obviously 5.95. The interest rates might climax at that point because the fact that obviously the industry has already seen what's happened in the U.S. with inflation, and inflation's actually gone down. Actually, last time it was announced for July, it was 8.1. August was actually announced, it was actually 7.6, and it went up really quickly as a spike because they actually started including gas prices and used cars.
Right.
So because of that being included, which should have been from the very beginning anyways, it's changed the market dynamic, and a lot of things slowed down, especially for the summertime. Okay, but now that we're in the fall, you can see a lot more people kind of coming out of their home.
Buyers.
Exactly, yeah, and they're kind of starting putting housing on the market. So, example, like last week to this week, there was actually over 200 more listings than on average. So 200 new houses that have come on the market just this week compared to the week before. So you can kind of see that the market kind of changing. However, as you probably know, as the prices are kind of still just above last year's average. So 2021's average is still just above it. But it means it's a good time to buy. Okay? And we'll obviously talk about prices versus March and now.
Yeah. So can I ask you, so when I hear that an interest rate is about to go up or may go up, so I always recommend that anyone work with a broker now, get tied into a pre-approval now.
Yes.
Is that still the case? And if it were to go down, does that pre-approval get to change?
Yeah, good question. Okay, so I'll talk a couple things there.
Mm-hmm.
So when it comes to getting a pre-approval, it is very important to make sure you have something at least assigned to you. Now, the rate may not be assigned. That's very important. A lot of people think, well, the rate is assigned. It's not exactly assigned. What is assigned is if you do go with fixed, then yes, the rate is assigned. Okay, but if you do go with variable, then what happens is the rate is not assigned, but the discount is. So example, 5.45 is the interest rate right now. A lot of lenders are giving 0.90 of a discount. Obviously, if the interest rates go up, you'll still get that 0.9, but if the interest rates go down, hopefully you'll still maintain that 0.9, which means it'll be a little bit easier for you. So what happens though, kind of to your second question, obviously, is that the stress test definitely has something to do with that, because if the interest rates go up, then you won't be able to afford as much as you once were. So going back to what I just said before, sometimes it's beneficial to actually go with the fixed. I'm not saying I recommend that right now, okay? But sometimes it's beneficial to go with the fixed interest rate because you know how much you can afford. If the rates go up, you know you can still afford this because you're locked in for 120 days. Now that's 120 days till you actually close on the property, not 120 days till you actually find a house. That's very important to understand, right? But you have the ability to actually still afford something that you've been told back then opposed to when the rates go up. So that's really important. So yes, if by any chance we think the rates are going to go up, then I would really lock all my clients in to whatever I can get them into. Keep that in mind. It's kind of a little bit opposite with variable. If you do want the variable interest rate and the rates go up, unfortunately it will alter how much you can afford, because technically the rate is assigned, but it's only the discount that's been assigned. If the rates go up, then that's going to affect your stress test, which means how much you could actually afford. Vice versa, obviously the fixed.
Right. So the market has settled a little bit.
Yeah.
So we still have
for this week.
Yeah, we still have some people out there looking for homes. Mm-hmm. So do you want to give a quick comparison of what a house would have been in March of 2022 versus what it is today?
Yeah, this is actually a big question I get a lot of times, because I can't stress enough to a lot of clients the fact that it actually is better to buy a house today than it was actually back in March. And they don't see it that way, because they say the fact that, well, housing prices are very different. Yes, but keep that in mind. Interest rates are very different. Yes, but again, that's temporary. So, example, if you take the same home you could have bought in, let's say, March, you probably would have paid around $950,000 for it, single family home.
Sure.
Okay, but that same single family home, you probably could actually find for roughly about $200,000 to maybe even a bit more cheaper. Mm-hmm. Okay, now my philosophy is you marry the house, you date the rate. Okay, because the rate is actually temporary. So going back to that analogy, obviously, if that house is now $200,000 less, okay, so the house was here back up in March, and now it's down here, but the interest rates are the opposite. So the interest rates were down at maybe 2.5%, maybe 3%, and now they're closer to 5%, example. They've kind of spiked. It's the same actual payments, very, very close to being the same. I'm talking within $10 or $50 worth of sales on a monthly basis. But the biggest difference is how much money are you going to be able to save over the long run? You're usually in the house for 20 years, maybe 7 years. It doesn't matter, but because you're going to be in the house for a long period of time, you're actually going to make more money. Because a lot of my clients come to me and say, well, I'll take the 5-year rate. I said, wait a second. I appreciate that you want to go fixed, but maybe you should take a 2-year, maybe a 3-year, just to get over this hump and know the fact that, oh, well, the rates, stayed the same. Maybe. Or maybe they've gone back down, and then suddenly you can jump off and jump back onto a lower interest rate. And we're just talking about saving tens of thousands of dollars, because you have to remember, you still have 3 years left or 2 years left on your term, and that's a large time.
Right. So, another thing that I come across too is I'm not sure if a lot of homeowners know that they can potentially port their mortgage with them, because I think part of our relationship is that we're always, saving our clients more money and doing what's best for them, not just about getting a sale. So I think that the portable part of not paying penalties plays a big part of whether or not there's a consideration to sell and move.
It's true. It's true. So a lot of things I want to make sure I tell a lot of people who are watching this video, you need to talk to your lender. Each lender is different. I will talk about the general lenders, okay, the average lenders. So there's a lot of lenders out there where you can actually port your mortgage over, okay? And you take the amount that you have outstanding in your mortgage. So let's say you have a mortgage of $300,000, okay? And you're gonna sell your house, all right? And then you're gonna buy something bigger. But now you need more mortgage. So you have $300,000. It's at today's interest rate, so on and so forth, okay? But then you need another $150,000, maybe $200,000 on top. That $200,000 will actually be a separate rate. It will be today's rate. This actually stays the same from, 2019, but this is today's rate. Mm-hmm. That's really important. So most lenders will actually do a blended. They'll actually figure out how much time you have left in the first rate, what's the balance, okay? And then the second one, what's the balance and how much time. They'll actually do a blended rate, so they're actually molded together. And what normally happens is that the rate will expire actually at the time that the big portion expires, the first mortgage expires. So maybe you have 2 years left on it. Well, then guess what? The second mortgage is going to expire in 2 years. It's a blended.
So the benefit of that conversation is you're not paying a penalty to get out of the original.
Yeah.
You actually carry maybe the better rate with you
100%.
On the existing.
100%.
And then only pay today's rate at what the top up is.
Yeah. So furthermore, okay, so she's correct. So furthermore, one thing I didn't realize, this actually happened to myself personally, is that I actually had about $500,000 mortgage. I still had 2-3 years left on it, roughly. I was in a fixed interest rate. Nothing wrong, I had a great interest rate, but when the interest rates went down, I'm like, hey, I could jump off and get a new interest rate. We had kind of all explored that option. When I looked at it, I was part of the fixed interest rate, and there's actually a larger cost analogy. It's called IRD, or interest rate differential. They'll actually calculate how much time is left, how much money that you still owe them, basically in interest for the amount of time. It was going to cost me, I'm not making this up, it was going to cost me close to $30,000 to get out of the mortgage. So obviously if I was selling my house, that would have been $30,000 I would have saved, right? However, some people kind of don't like going with variable, but I like stats and I love history, but I also love math. And if somebody actually went with variable, yes, it's a lot more rocky, especially right now. It's a lot more rocky, but you could benefit from so much. So a lot of my clients right now, I'm telling them if they are risk tolerant to jump on that actual variable rate, okay, ride the wave. Yeah, maybe it'll go back up by 0.5%, right? But it most likely will go back down. And what happens when it goes down, the fixed rate will also go down with it. And what you could do is you could jump off and then jump back on the fixed at maybe 3.25. And then suddenly like, wow, because it's only going to cost you 3 months of interest to get out of the variable in your mortgage.
Right.
It's a huge savings.
It's all about saving money, right? And making your money work for you.
Yeah.
So I think the most important reason why I brought Tim on is I would love everybody to know the difference between just going into the bank, walking in a door and seeing a mortgage specialist versus having a broker explore, a whole bunch of others. I'll let you explain that.
Okay, so I've worked in the industry for over 10 years. I've worked for the big banks, okay, the green and the blue, all right? And I've seen a lot. Now you have to understand the fact that when you walk to a branch, you're talking to somebody who's sitting behind a desk who's probably making $18 an hour, okay? Do they know mortgages? Probably not. Maybe their own experience, whatever the case is. But they're also in charge of credit cards. They're in charge of children's accounts and setting up your own bank account, maybe a tax-free savings account. They're in charge of over 30 different products. At least that's what I was when I was in that position. But to redo a mortgage, suddenly you're trying to assume that you're going to be giving this information to the person in front of you and they know what they're doing with it. Most of the times we read the computer screen with the client right there telling us. And if I've misentered information, especially income information, I can put you in a whole world of trouble. And that actually does happen. The other thing is also with banks, you have to understand is the fact that banks usually tend to have higher interest rates. And people are like, why? Like, well, probably because they're a good product. It doesn't necessarily mean a good product. I mean, we've all shopped on Amazon these days, obviously, instead of walking into a store because we know we can get the same product but at a better price. That's exactly what brokers do. They get exactly the same product. Actually, I deal with 6 banks, actually over 6 banks. So that's a lot of banks I can still go to. So I see what banks offer. I also see what other A lenders offer who don't actually have branches or stores where the case is. They don't have AC and water to pay for, or heat or hydro, or tellers that sit there and do nothing. But yeah, they definitely have the opportunity to offer a little bit of a discount because they don't have those brick and mortar stores to pay for the electricity.
So I always tell my clients that it's important to have everybody work for your money. So in my opinion, it's better to have everybody work for your money. So a broker will explore many options, right?
Yep. A
lenders, B lenders for those that may need it. And just to clarify, I guess some misconceptions, A lenders are not just big banks, right?
No.
There are other options.
Yeah, actually, there's several A lenders that I have in my Rolodex that actually are bigger than some of the banks. I'm being serious, actually. People are like, really? I'm like, yeah, actually. They don't realize it because they don't have a place to walk into. A lot of my clients are like, well, will I walk into the branch? Well, I know for a fact the 500 clients I've ever had, maybe, I'm not kidding, maybe 50 of them max have ever walked into the bank after the mortgage is funded to ask a question.
Right.
Okay? Most of the time they call me. And if I don't have the answer, I'll get the answer for them, or I'll direct them to the right phone number to call, or the right website to go to, or what right form to fill out, whatever the case is. That happens a lot of the time. Another big thing is also banks, they don't fight for your business. They just don't. And I have a lot of clients who come to me like, wow, I've been with my bank for 15 years. They treat me like I'm nobody. I'm like, yeah, because they already have your business.
Right.
That's a big thing. With brokers, we will fight for you. And even upon renewals, because we were talking about that earlier, upon renewals, we'll keep fighting for you and try to get you a better rate. And even if that means we get to send you to another A lender or another bank, whatever the case is, we'll fight. We'll do all the hard work for you just to make sure that you can save that much more money. And people are like, oh, it's not that much. Trust me. Even like 0.25% or even 0.15 is still a very big difference, especially with the interest rates being where they are today. Okay, but it's a very, very big difference.
Yeah. So I think in my personal experience, when you walk into a bank, they don't know my name, they don't know anything, and I think if anything, the pandemic's taught us that we can do everything online.
Yeah.
And I do think that when I deal with Tim and a client, he has the ability to talk to the lender personally.
I do.
Give the backstory, give a little bit more of a personal touch to that application versus it's just being over a computer and sent to an
100%.
underwriting department.
100%. I'm
Yeah.
going to go back to that whole B lender, okay? So a lot of people think, oh, my credit's not that great. Okay, it doesn't mean it's not great forever. It's just not great maybe today.
Mm-hmm.
So a lot of people I try to coach and saying, like, look, going to a B lender is not a bad thing. It gets you in the house. It gets you not paying rent or somebody else's mortgage for that matter.
Yeah.
It gets you into the house. But you can go on a 1 year, 2 year term, fix your credit, show the fact that you can pay off a mortgage, that you're actually responsible, which you are. We all know you are.
Mm-hmm.
But things may have changed, obviously. And then we can get you into an A lender, which maybe have a different, obviously. But people think B lenders are bad. Like, they're not bad. They just have different fees up front or whatever the case is because they're taking on more risk tolerance
Mm-hmm.
because of whatever situation you're going through.
Right.
And I have a lot of clients. Like, I'll give you an example. I have some clients who choose not to pay themselves a lot of money because they're self-employed.
Mm-hmm.
That happens a lot. I mean,
does.
why wouldn't we, right?
Mm-hmm.
But because they don't pay themselves enough, A lenders can only go X amount more. And it's not by much, by
Right.
the way. But B lenders can go X amount even more. And it doesn't mean that you're not a bad person. It just means the fact that you choose to keep the money in your company.
Right.
And that happens to everybody.
Mm-hmm.
But the B lenders aren't charging an astronomical price. People are like, well, what do you mean? I'm like, okay, well, if I'm at 4.5%, example for a variable, a B lender could be at 5.25%. Maybe 5.5%. It's not that big of a difference. Yes, it is because I just said obviously
Right.
0.25%. But when you're getting out of this and you're
Yeah.
saving money off your taxes and so on and so forth, it's worth it.
Or let alone not throwing away your rent money.
Exactly.
Right. So this has been Tim. Tim, why don't you give us your contact information? We'll put it in the
Sounds
information below.
Yeah, so obviously my name is Tim McCaroll. I am your mortgage expert. I'm definitely referred as that. You can easily reach me at 613-878-2626. Very simple number. I made it up. I'm not making this up. I had to ask for it. Just keep it simple. And you can also reach out to me at tim@referralmortgages.com.
All right. Thanks for tuning in today, and hopefully you found this resourceful. And drop by next week, see who we got.
Sounds good. Thank you.